Hey guys, welcome back to The Market is Open. Visit our website, themarketisopen.com. In this video, we're going to talk about a whole bunch of news from this week. We'll start with a brief overview of the impact report that Tesla released and some insights from that. We'll also talk about a slew of analysts downgrading Tesla stock. Elon Musk had tweeted a few weeks back that Tesla stock was too high in his opinion, and the stock took an initial hit but then came roaring back. Now Elon Musk tweeted LOL and mentioned stonks, and the stock market took a tumble. Now I don't think it's related, but that's what happened. And finally, let's briefly look at what happened with Nikola from earlier this week and Elon Musk pushing for Tesla Semi to enter volume production. But first, please hit the bell button to subscribe and be notified of upcoming Tesla videos, and smash the like button to help support this video. You can also support us further on Patreon at patreon.com/themarketisopen, where we give a shout out to our patrons at the end of each video. Okay, so Tesla released their 2019 impact report this week, which talks about Tesla's environmental impact, their product and supply chain, and the impact on the community and people. Now, I'm not going to go over the full report at all, but I'd like to look at a small number of things that I thought were interesting. The first is related to Tesla's energy division. So Tesla's vehicles, of course, are a major focus to shareholders. However, the Megapack is pretty exciting for the energy side of things. Tesla says that the Megapack has a 60% increase in density over the Power Pack, and I believe we already knew this. However, they can install the Megapack 4 times faster than an equivalent fossil fuel power plant. So Tesla's really taking aim at the dirty, polluting peaker plants, and Megapack will save customers money, but it's still an expensive product. So I think this will finally help put the energy division on the map by making sales to large commercial customers where a lot of the money is. Furthermore, one of the things that investors or even potential investors had concern over was cobalt in batteries. So cobalt is a small but expensive component of batteries, and Tesla has been striving to remove cobalt from its batteries over time. Actually, the new LFP batteries that Tesla is using in its China-made vehicles have no cobalt. Nonetheless, Tesla states in their environmental impact report that cobalt is coming from mines that meet their ethical, social, and environmental standards. Now, on top of that, they recycle 100% of old batteries from Teslas, taking out valuable materials, including cobalt, which they've already recycled 110 tons of in 2019, and they're going to recycle even more as Teslas on the road get older over time. Now, I think Tesla's corporate governance slide actually has some of the best insight about the company in general. So they say that they want to manufacture and sell electric vehicles from the ground up rather than simply build powertrains for OEMs. So I think that's exactly what's been happening, and that's exactly what investors should want. I think controlling the full end-to-end experience for the customer and the full supply chain makes Tesla very competitive and in control of their own brand. And a lot of people have been saying that Tesla should simply sell their powertrains and stuff to other OEMs, but clearly this isn't going to be the case. At the same time, Tesla doesn't want to use the franchise dealer systems, and they want to use their own stores and service centers. So again, this is a huge benefit. It makes Tesla more nimble. It cuts out the middleman. And also, if there's a problem or unhappy customer, Tesla takes care of it, which isn't really true for the franchise dealerships, where they don't seem to really care about you at all. Now, the next three things, creating a global network of superchargers, building the world's largest battery factory to meet and reduce battery costs, and expanding into energy generation, which is solar and storage. All of these things are long-term decisions that have been made, which you won't really see the benefits of years down the road. However, thanks to many of the investments that Tesla has made years ago, I think some of these are finally starting to pay off, and some of these still won't pay off until long into the future. So I think Tesla is really focused on making long-term decisions to create long-term value for shareholders. And finally, from this list, they say that they will only compensate their CEO, Elon Musk, only if other shareholders realize tremendous value. So aligning the incentives of the company and employees and shareholders is extremely important, and many other companies seem to get this wrong. Tesla employees are incentivized to invest in the future and not make near-term decisions and profit decisions that have no long-term value. And since most of Tesla's value comes from the future earnings and growth, I think it's very much related to today's stock price. But as you'll soon see, Tesla analysts seem to be more short-sighted about this. So let's switch gears a bit here and look at what Tesla analysts had to say this week. But first of all, I was watching somebody named Rick Newman on Yahoo Finance on some random video. And one of the takeaways was that, first off, he was sort of bearish on the stock and on Elon Musk in general. But he mentioned that the run-up in Tesla stock clearly had nothing to do with Elon Musk pumping or promoting the stock. It was actually the opposite, because Elon had even tweeted that the stock was too high in his opinion, and the stock hit $1,025 per share a couple weeks later anyway, after he had tweeted. So I think that this is something that we mentioned before, was one reason that Elon Musk had tweeted that the stock was too high, in his opinion, was to distance himself from any criticism that he had pumped the stock in order to get a payday. So I think that's very smart of him, and it's a very good partial explanation that we gave earlier as to why he would have done something like that. Nonetheless, we had a few analysts who downgraded Tesla stock after it hit over $1,000 per share. To be fair, the market took a huge dump on itself this week, falling almost 2,000 points on the Dow on Thursday, and then it bounced back a little bit on Friday. Now, despite the huge decline in the market, Tesla stock held up pretty well, even though it was down on a day where the market was up. But like I've said before, Tesla sort of has a mind of its own, and it's really not correlated to the market, which is a benefit for diversifying portfolios. Now, on Thursday, Elon also laughed at the Tesla stock price, which people are saying started the decline in the stock. Sure, I don't really think that's the case. The best part of this, I thought, was that on Yahoo Finance, they said that Elon had tweeted the word stonks, which is a financial term for when stocks get too high. I actually almost died laughing when I saw this Yahoo reporting on this. Stonks is not a financial term in any way. Okay, so the first analyst downgrade came from Morgan Stanley's Adam Jonas, which downgraded the stock by $30 to $650 per share. First of all, their track record on Tesla has been horrendous. If you listened to them, you would have missed out on this huge rally, which is evident based on their old price target of 680, which is just nowhere near where Tesla stock has been trading. What exactly does going from 680 to 650 mean right now when the stock is in the $900s or $1,000 range? It's just two made up numbers. So they're citing near-term demand, which is already a red flag. As a shareholder, you should be in the stock for the long term. Tesla even says in their impact report that they want people on their team or on their board willing to make near-term sacrifices, basically in order to gain long-term shareholder value. So citing near-term demand as an issue is not really in line with Tesla's values and shows Morgan Stanley's misunderstanding of the stock. Also, there's no near-term demand problem. It's another made-up data point that Morgan Stanley must be looking at. Now, their other concern is about the Fremont ramp-up. I think that makes a little bit more sense because now we're talking about production, which is the real constraint, not demand. That said, I think everyone is trying to ramp up sort of back to where they were before the global health crisis. And I actually think Tesla will be able to surpass that level for one reason, because they upgraded the factory a whole bunch of times while it was shut down. So I think they will come out of this even stronger than when they went in. Furthermore, China seems to be doing quite well. However, Morgan Stanley is concerned about relations with the US and China. I actually think that China really likes Tesla, but I admire the concern. And I think it'll be great for people to sort of trade and buy and sell Tesla every time somebody mentions the word China. However, Tesla sold 11,000 cars in China last month, which was up triple from the previous month. So I think Morgan Stanley can probably buy the stock back later when it's much higher. Also, analysts are worried about Tesla's price cuts, which weren't in their models. By the way, Morgan Stanley's model forecasts Tesla stock in a range of $190 to $1,200 per share. So their model is pretty useless in my opinion because it's not actually forecasting anything. Also, you should expect Tesla to continue cutting price in the future as they remove costs from their vehicles and try to hit larger mass markets. So if you don't have that in your model by now, you're simply not thinking about the future or even following Tesla's stock. Morgan Stanley also says that more powerful players like Amazon are positioned to deploy capital and talent to solve autonomy and will compete with Tesla and General Motors. So I do think Amazon is very powerful and they do have a lot of money. But other than that, I don't really see what the advantage that Amazon has over Tesla. They have no data and they have no vehicles. If anything, they're behind Google's Waymo, which is having problems of its own. And I would say Google is just as powerful as Amazon when it comes to capital and talent. Amazon may also get their 100,000 delivery vans that they ordered from Rivian in about a decade. We also saw this week that Goldman Sachs downgraded Tesla to neutral from a buy, but actually raised their price target to $950 per share. They seem to be a little bit more bullish on the stock and are waiting for the price to come down a bit. So I actually like this downgrade. I think it makes a little bit more sense at least, and is more opportunistic of Goldman to wait to get in at a better price. Now, they do cite near-term challenges in production and price cuts, same as Morgan Stanley, but I find that strange that they're supposed to be forecasting 12 months out and they're busy focusing on the near term. So I'm just saying they might miss something big by focusing on what will happen over the next few weeks versus the next few years. Goldman also upgraded General Motors, saying it's well positioned for the US pickup truck market. GM has no electric pickup truck offering on the market so far. They're planning to start with a Hummer, which we talked about in our Tesla Rivals video. So I don't know, I wouldn't want to stand in front of the Cybertruck steamroller when I know it's coming down the pipe within a few years. Like, we know it's coming, and I wouldn't want to risk it wrecking the entire pickup truck market for these automakers that depend on the current dominance that they have and their high margins. Now, this week we also saw Nikola stock reach absurd valuations of $30 billion. We talked about it in our video here. I'll put a link in the description. Basically, Nikola is a competitor, so-called competitor to Tesla. They're planning to make hydrogen and electric vehicles and a whole bunch of different vehicles. They actually don't sell any products yet, and their planned trucks are more expensive than Tesla Semi. Elon Musk also said that he wants an all-out ramp-up of the Tesla Semi in volume production. So again, I don't see the logic of getting in the way of that. Nikola is planning for an electric and hydrogen truck. I'm not sure how they plan to do both and compete effectively. I think that the stock is mainly hype. Their hydrogen truck could work. They're just simply not a Tesla competitor, and they're not worth $30 billion. If anything, NIO stock, which we don't really like, is looking better than Nikola with a lower valuation. They actually make cars, and they have a strategy, which I don't like, but at least they have a strategy. And the Chinese government won't let them go bankrupt, even though they should have been bankrupt like 5 times over already. Nikola, on the other hand, has a few hundred employees. Remember, Tesla has 50,000. So, like, who's writing their software? Who's manufacturing their vehicles? I think Nikola is aiming to be a niche player that sells a small number of vehicles. It seems like they're outsourcing everything and they don't actually do very much themselves. They create a whole bunch of concepts, but they don't have a proven track record of manufacturing anything. And their focus seems to be way too widespread. They're trying to do everything and they're going to end up doing nothing. So the thing I like about Tesla is that they do say no to a lot of ideas, and I believe that's going to strengthen their focus and make them a true competitor to basically everyone in the industry in the long term. Alright guys, I hope you enjoyed this video. Please hit the bell button to subscribe and be notified of upcoming Tesla videos. And please smash the like button to help support this video. We'd super appreciate that. You can also support us further on Patreon at patreon.com/themarketisopen, where we give a shout out to our patrons at the end of each video. Thanks so much for watching.